In recent days, I've noticed many local finfluencers reigniting an old debate on which strategy works best: crash buying, lump sum investing, or dollar cost averaging (DCA). The very fact that this debate refuses to die tells us that each approach works. If it didn't, there wouldn't be three vocal camps confidently defending their methods. The proponents in each camp have likely benefited from practicing what they preach. Crash buyers capitalize on fear and volatility. Lump sum investors maximize time in the market. DCA practitioners prioritize discipline and emotional comfort. All three approaches can build wealth, provided they are executed consistently within a sound overall financial plan. If you are a new investor, the most important thing is not choosing the perfect strategy. It is choosing the one you are comfortable sticking with. A strategy that keeps you invested through market cycles will almost always outperform a superior strategy that you abandon midway. I personally think this should not even be a topic of debate. It is more a matter of ability. A person without a large pool of savings would not be able to do lump sums investing. Also, a person's lump sum could be another's DCA. For example, Lou fired a few $50,000 to $100,000 shots when the S&P 500 was tanking. In a way, he was doing DCA over that short period. But those $50,000 to $100,000 shots would be lump sums to many of us. I think it is more important to look at the fundamentals. To be able to do meaningful DCA, one needs to have either constant income or a large pool of savings or both. For the young working adults, they are unlikely to have a large pool of savings, so only DCA is the reality for them. I would think it is better to focus on securing that source of income because no income, no ability to DCA, period. For those who are older and with large pools of savings, the question is, do you really want to expose that savings to the vagaries of the market, or would you rather keep it somewhere safe but with steady and lower returns? As a senior, 60 and above are considered seniors, I have become conservative and would go for safer. Low-hanging fruits, the CPF, so we do DCA into our CPF. 2 years ago, when we attained 3M60 couple, we realized our CPF savings can grow $200,000 yearly from there. The $200,000 would come from $100,000 interest and $100,000 from DCA, MC, VCMA, RSTU, and VC3A. 4M65 was possible and no longer a dream. With 4M65, we could extract $130,000 to $140,000 passive income annually from it for life. Have you ever wondered what's the best way to grow your money? Let's talk about a few strategies that have worked for me. First, let's look at something many of us have: our CPF. I once made a projection for my own CPF growth. I thought I'd hit $3 million by age 60, then $3.2 million at 61, and eventually $4 million at 65. It seemed like a smooth, predictable path. But then, T-bills came into the picture with higher interest rates. The reality turned out to be even better. I hit $3.2 million at 61 and even reached $3.5 million by 62. The CPF's growth is pretty much guaranteed by the government, making it a solid foundation for our later years. So, what should your investment focus be? It really depends on your age. When you're young, the absolute best investment is in yourself and your career. Focus on securing and growing your income. Don't get too caught up in debates about lump sum versus regular investing. Your earning power is your biggest asset at this stage. As you get older and have more responsibilities, it's often wiser to go for the safer, lower-hanging fruit. Think about things like contributing more to your CPF. Higher-risk investments might offer bigger rewards, but they also carry the risk of a bigger fall. Remember, just like our CPF is guaranteed to grow, so is our age. But there's a difference between your calendar age and your biological age. I see it at my class reunions. Some friends look youthful, while others look much older. Your health is your wealth, so take care of your body. Now, let's dive into 3 popular investment approaches: staying invested, investing regularly, and buying during a crash. Which one is best? Let's start with staying invested. I'm a long-term investor, not a trader. When I buy a stock, my plan is to hold it forever unless something major happens like a buyout. Over the years, this strategy has served me well. I've had some stocks that became multi-baggers, growing many times their original value. Of course, a few didn't make it, but thankfully, those were rare. Many investment gurus say you need to stay in the market through all its ups and downs to see real long-term growth and avoid making emotional decisions. Based on my own experience, I have to say this is largely true. Next up is regular investing. In recent years, as my big financial commitments like my mortgage and my kids' education costs have gone down and my income has gone up, I started investing a set amount every month. The common wisdom here is that this builds discipline and helps you average out the market's volatility. You buy more when prices are low and less when they're high, which can lower your average cost per share over time. It also takes a lot of the emotion out of the equation. I completely agree with this view. It's a steady, reliable way to build wealth. Finally, what about crash buying? This is when you invest a larger sum of money when the market takes a big dip. I've personally benefited from this during the 2008 global financial crisis and the 2020 COVID crash. That's why I always keep a war chest of cash ready. I definitely do it again. But here's the catch: you can never perfectly time the bottom. I've bought in thinking it was the bottom, only to see prices fall further. So it's crucial to have a clear plan for how you'll deploy that war chest. Don't just throw it all in at once. So which strategy wins? Here's my conclusion. You don't have to choose just one. All 3 approaches, staying invested, regular investing, and crash buying, can work together beautifully as part of a long-term plan. Staying invested and regular investing give you the power of compounding and discipline. Crash buying gives you the opportunity to turbocharge your growth by buying great assets when they re-on sale. Ultimately, successful investing isn't about finding the perfect, most optimized strategy. It's about your behavior and how you manage your emotions. The best strategy isn't the one that wins a debate online. It's the one that you can stick with, the one that keeps you disciplined, and most importantly, the one that lets you sleep well at night. Thanks for watching. If you found this helpful, be sure to like this video and subscribe for more insights. See you next time.